Chapter 4, Clearing, Settlement and Risk Management. We had been seeing a lot of issues with regard to clearing of the transactions and settlement of the transactions. There are certain margin issues that will crop up during this clearing and settlement process. So these margin issues are a part of risk management, because a person who is supposed to make payment with regard to the purchase of securities what they have done, they may not try to satisfy the payment conditions as per the date of pay in or either pay out. So there are a lot of margin issues that will keep arising from time to time when the transactions are taking place in the market on a daily basis. Now, what are these margins? Why these margins arise, and what sort of margins can create issues within the transactions? In addition to that, how we can address this margin issues by taking initial margins to the extent of the volatility, to the extent of the risk, or maybe to the extent of the maximum risk that is expected out of the transactions or out of the volatility of a particular security or volatility of a particular index. So now these margins we will try to address in detail. Margins form a key part of the risk management system. In the stock markets, there is always uncertainty in the movement of the security prices. This uncertainty leads to risk, which is addressed by margining system of stock markets. Let us try to understand these concepts of margins with the help of a particular simple example. Suppose an investor purchases 1000 shares of XYZ company at a price of 100 rupees per share on January 1, 2008. He is deemed to have purchased 1 lakh rupees worth of shares. How? 1000 shares into 100 rupees per share. So 1 lakh worth of shares he has bought on 1st of January 2008. He has to pay this 1 lakh on or before January 2, 2008, that is the next day. The broker in turn has to give this money to the stock exchange on January 3rd, 2008, that is the following day. There is always a small chance investor may not be able to bring this required amount by the required date, that is 2nd of January 2008, he may not be able to make the payment. As an advance for buying these shares of 1 lakh worth, investor is required to pay a portion of the total amount of 1 lakh to the broker at the time of placing the order. That means when he places the order, he is placing the order for a value of 1 lakh, which he has to pay on the following day, that is on 2nd January. However, at the time of placing this order for 1 lakh value of shares, he need not make the full payment immediately to the broker. He can make a partial payment at the time of placing the order. Fine. Now, stock exchange in turn collects similar amount from the broker upon execution of this particular order. So the client at the time of placing the order, he has to pay certain margin amount, certain part of the value of the contract or of value of the purchase he has made. Secondly, the broker in turn makes such payment to the exchange also. This sort of initial amount which they pay at the time of placing order is initial token payment, which is called the margin. It is important to remember that every buyer there is a seller, and if the buyer does not bring the money, seller may not give his or her money and vice versa. Therefore, margin is levied on the seller also to ensure that he or she gives the 100 shares sold to the broker, who in turn gives it to the exchange. So whether it is 100 shares or 1000 shares, whatever has been sold by a person also has to satisfy the delivery conditions on the pay in day. In case if he is not able to make that delivery of shares, he may enter into a default situations. To face such a situation, the broker is expecting certain margin amount payment from the seller also, which in turn is paid to the exchange. This is just to ensure that the seller also meets the criteria of delivery of securities. In the above example, let us assume this particular security which the client has made the order has a margin percentage which he has to place or make a payment at the time of placing the order, let us say is 15%. That means investor has to give 15,000, which is 15% of 1 lakh worth of shares, which he has placed on 1st January to buy certain securities. This he has to pay to the broker before buying, that is at the time of placing the order for the purchase. Now suppose investor bought these shares at 11 AM on 1st of January 2008. Assume that by the end of the day, the price of the share falls by 25 rupees per share. That means he has placed an order for 100 rupees per share for 1000 shares. So he placed the order for 1 lakh value of shares and that order has been executed. Fine. Now after execution of this order, the margin amount which he has paid is only 15,000 at the time of placing order, and this order is executed, and the balance amount he can make the payment by the second day, that is on 2nd of January. Fine. Now if the stock price of this particular security falls from 100 rupees to 75 rupees, that is 25 rupees fall in the stock price by the closing of the day of transactions at the stock exchange for this particular stock, what happens in such cases? There will be certain loss of 25,000 rupees, because 25 rupees per share fall into 1000 shares what he has placed an order and which was executed. This comes to 25,000 rupees will be the loss of this particular security for the buyer who has purchased at 100 rupees today. In our example, the buyer has paid only 15,000 till now as margin, but the notional loss which arises because of the fall in the price on that particular day is 25,000. That is notional loss which is more than the margin he has paid. So he paid 15,000 and bought 1 lakh worth of shares whose value has fallen by 25,000 rupees by end of the day. So he is in a loss of 25,000 rupees. So the actual payment he has done till now to the broker is only 15,000, but whereas the notional loss of his portfolio, of his stock value which he bought today has become 75,000. That means 25,000 is the actual portfolio or notional loss. In such a situation, the buyer may not be willing to pay the total 1 lakh for the shares whose value has come down to 75,000 rupees. Similarly, if the price has gone up by 25 rupees, the seller may not want to give the shares at 100 rupees. So the seller who has sold today at 100 rupees to us, he would feel that he is making a loss by selling at a lower price because the closing price has been 125 rupees. So the delivery is not yet effected by the seller. The delivery will be effected after a day, but he has paid only an initial margin of 15,000 rupees at the time of selling of this particular security. So he is foregoing a profit of around 10,000 rupees. So both cases there can be issues when the stock prices goes down by the end of the day, or if the stock price goes up by the end of the day. If the stock price goes down by 25 rupees on that particular day, the buyer may not be willing to, may not be interested to make the balance payment and take delivery of the shares, because once he takes delivery of the shares, If he wants to sell, he may be only getting 75,000 rupees because the market price has fallen down. Similarly, if the stock price moves from 100 to 125 by closing of the market on that particular day, the seller who has only paid 15,000 rupees as margin would be not interested to deliver the securities, because he would be foregoing 10,000 rupees profit on the sale what he has done. So, he may be not comfortable to deliver the securities. That is the reason why the exchange has designed a proper risk management system, so that both the parties, irrespective of the price closing on that particular day, they will be able to adhere to the regulations and accordingly satisfy the delivery conditions, the pay-in and payout of the securities, and as well as the monies required. To ensure both buyers and seller fulfill their obligation, irrespective of such price movements, notional losses are also need to be collected. Prices of shares keep on moving every day. Margins ensure that buyers bring money and sellers bring shares to complete their obligation, even though prices have moved up or prices have moved down. Now, imposition of margins. Now, we have just taken for example 15% as a margin for the security, as just a simple example, but every security has got its own volatility, its own risk factor, because of the aggressive moves, nominal moves or small moves the security makes. So, the risk movement or the volatile movement that can take place in security varies from security to security daily basis. So, to arrive at this particular percentage of initial margin which has to be paid by the buyer or by the seller has to be computed or arrived depending on various conditions. Now, for imposition of margins, the stocks are categorized on basis of their trading frequency and impact cost. The criteria for categorization of stocks for imposition of margins is mentioned as follows. 1. The securities are classified into 3 groups based on their liquidity. Liquidity means the dependency on the activity of that particular security on a day-to-day basis. The stocks which have traded at least 80% of the days for the last previous 6 months will constitute group 1 of securities. These are considered to be liquid securities category, and group 2 is considered to be less liquid securities. And out of the scrips identified above, the scrips having mean impact cost of less than or equal to 1% are categorized under group 1, and scrips where impact cost is more than 1 are categorized under group 2. The remaining stocks are classified into group 3 illiquid securities. This is how the securities are divided into 3 categories, that is group 1, group 2, group 3. Now, let us try to see what are these groups. Now, if you see this particular table 4.5 for imposition of margins, we can see liquid groups or liquid securities group 1, less liquid securities group 2, and illiquid securities group 3. Now, the trading frequency for each category, when we check for the previous 6 months activity of these securities, for liquid securities it is 80% of the time they are traded in the previous 6 months, whereas in second group they also have traded at least 80% of the time in the last 6 months. Similarly, illiquid securities are securities which would have traded 80% of the time in the last 6 months. That is, they have not traded equal to or more than 80% of the time in the last 6 months. Now, For category 1, for group 1, the impact cost in the last 6 months activity is less than or equal to 1%. So, impact cost is also one of the important concept for calculating and arriving the securities group category. Then impact cost, if it is more than 1% and it has traded 80% of the time in the last 6 months, it will be put in less liquid group securities, that is group 2. And for the third category, illiquid securities, the impact cost is not taken into account. So, impact cost is a methodology of calculating the actual value at which we can get the security. That is what constitutes impact cost, which will be dealt more in the derivative segment, dealer module segment. Now, the impact cost, how it is calculated? It is calculated on 15th of each month on a rolling basis, considering the order book snapshots, that is the order book details of the previous 6 months. On the basis of the impact cost so calculated, the scrips are moved from one group to another group from first of the next month. That means on 15th of every month, they will first calculate the impact cost for each and every security. If it is falling less than 1%, it is under group 1. If it falls more than 1%, then it is moved to group 2 from the following month, first of the following month. This is how these securities are calculated and categorized as per the groups. This will help us to fix what can be the margin structures for different securities based on this grouping of securities. That means if it is following to group 1, the margin structure may be different. For group 2, the margin structure can be different. For group 3, the margin structure will be different, because 3 category of stocks are having 3 different volatility, 3 different risk contents in these securities. So, these will help us to fix what can be the margin structures for the securities. Categorization of newly listed securities. For newly listed securities, they do not have the past history. For grouping of securities, we require at least 6 months activity, so that we can calculate impact cost. We can also see whether the securities have traded 80% of the time or not. But for new securities, it may be very difficult, because there is no past record or past activity of those securities to put them into a particular category. So, what are we to do for such securities? 1. For the first month until the time of monthly review, a newly listed security is categorized in that group where market capitalization of the newly listed security exceeds or equals the market capitalization of 80% of the securities in that particular group. Subsequently, after 1 month, whenever the next month review is carried out, that is on the second month after the listing, on 15th of the second month, the actual trading frequency and the impact cost for that particular security is computed to determine the liquidity categorization of such securities. So, we use the market capitalization of that particular security to enable us to put in a particular category. Market capitalization, as we have already seen, market capitalization of a security is calculated by taking the market price and the number of outstanding shares of that particular issue. Then only the market capitalization is arrived. So, for such securities which is listed for the first time, they take the market capitalization of that particular security and then try to put in the proper category in the groups which we have discussed. And once the record is developed, after a history is developed for a month or so, then from the following month the impact cost and other issues will be calculated, and accordingly they can be put into various categories what we have discussed in these 3 groups. In case of any other corporate action results in a change in ISIN number, International Securities Identification Number, which we have already discussed, then the securities bearing the new ISIN is treated as if it is a newly listed security for group categorization. That means, if a security undergoes a change in ISIN number, in such cases the security will be accordingly changed as if it is taken as a new listed security and put in the right category. Now, what are the various types of margins which we can impose to the clients or by the exchange to the brokers depending upon various factors? Now, we have discussed what are the three categories of securities. Now, these three categories of securities can be used for arriving at the margin structures which the client or the broker has to pay to the necessary respective people depending upon the security, depending upon their category, depending upon these three factors which we will be discussing now. Daily margins payable by the trading member in the cash market consists of following categories to arrive at the margins: value at risk margin, which is called VAR, mark to market margin, that is called MTM, then extreme loss margin. So, these are the three ways of calculating the margin for these securities which are put under different groups. The margins are computed at client level. A member entering an order needs to enter the client code first. That means, the trading member who is placing an order, he has to mention the client code on whose behalf he is placing this particular order. Based on this understanding, margin is computed at the client level. So, for a particular client, a particular margin structure, if it is fixed, at the same time the client code which is given at the time of placing the order will help us to assess and establish what is the margin structure that has to be paid at the time of placing the order. Now, let us see in detail what is meant by these margin and how are these margins arrived. First, let us discuss about VAR margin, that is value at risk margin. VAR is a single number, that is a certain percentage which is calculated based on certain formula which encapsulates whole information about the risk in a particular portfolio or in a security. It measures, what does it measure? The potential loss from an unlikely adverse event in a normal market environment. Okay. This involves using historical data on the market prices and the rates, the current portfolio positions and the model, like examples option models, bond models, for pricing of those positions. These inputs are then combined in different ways depending on the method to derive an estimate of a particular percentile of the loss distribution, typically the 99th percentile loss. Now, let us try to see what is this computation of VAR margin. VAR margin is a margin intended to cover the largest loss that can be encountered on 99% of the days. So, it takes a percentage to arrive which will help us to expect the maximum movement the stock can make in 99% of the time in the future. This is arrived using the past action of that particular stock. For liquid securities, the margin covers 1 day losses, while for illiquid securities it covers 3 days losses, so as to allow clearing corporation to liquidate the position over 3 days. That means, they take into consideration 1 day's volatility of a stock which is a highly liquid stock, as we have discussed in group 1. For other stocks which are illiquid, like the group 3 stocks, they take the movement of at least 3 days as a base for understanding the volatility and arriving at the margin for such securities. This leads to certain scaling factor of square root of 3 for illiquid securities on this particular volatility. For liquid securities, the VR margins are based only on volatility of the securities, while for other securities the volatility of the market index is also used in the place of security volatility. We have seen how grouping of securities in different groups, 1, 2, how margins can be used or calculated for purpose of arriving at the amounts that need to be paid at the client level, at the broker level, etc. When we are arriving at calculating based on certain criteria, the margin structures the clients or the trading members have to pay for a particular securities of a particular group can be in detail get into such calculation as follows. 1. We need to understand what are all the definitions used in this particular calculation of margins.